Ever since earnings dropped 39% during the Great Recession of 2008 into the spring of 2009, the S&P 500 businesses have had really great years, with only blemish being the COVID pandemic, where earnings once again fell by 16%. Otherwise, the businesses in the S&P 500 have grown earnings at a rate of 11.68%, including estimates for this year and the next 2 years. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. And I don't know if you guys noticed it or not, but I've been a lot happier lately than I have been over the last couple of years. And as a value investor, the reason I'm happy is I'm starting to see value in this market where value hasn't been in a long, long time. So let's go ahead and get into FastGraphs and let's look at the SPY, the ETF, the S&P 500 ETF trust. And what I want to show you here is obviously we're looking at the earnings per share of the S&P 500, and they've grown very well in the, roughly 13 years plus since the market has, had the drop in 2008 and 2009. But as I look at all the other metrics, operating cash flow has grown at 8.76% since that time. Free cash flow in the aggregate for these businesses have grown by over 12.7%. Remember, that's the cash that's left over after all these businesses needed to spend on keeping their businesses afloat. We can look at EBITDA, and we see EBITDA grew at over 8% during this period of time. And then when we look at sales, we see that sales grew by 6%. So all in all, you would say that the S&P 500 has had some really good operating results since coming out of the last real recession that we've had. And of course, it's still debatable whether we're actually in a recession now or not. But let's look at the all-important weekly closing stock prices and correlate them to operating earnings per share. And what I want you to see here is that I like a 15 PE ratio because it represents a 6.5% earnings yield. And you can see that coming out of the Great Recession, we had a little bit of optimism for a year, but generally for the next roughly 3+ years, the S&P 500 traded within what I would consider a very close proximity to fair value or true worth value. In other words, the market I felt was fairly valued. Then starting early in 2012, it began to get overvalued, and it was overvalued for most of 2013. And the normal PE ratio during this time frame ballooned up to about 19 from trading somewhere around the 15 range that I talked about earlier. But then things even got more sublime. Coming out of COVID, the market got really irrational, exuberant again, and the stock values ballooned up. The PE ratios ballooned up to over 23 times earnings. And the point I want to make is since the beginning of 2022, and I've got January 7th here, that's the end of the first week, the market's fallen around 23%. Back that up a little bit, and I'm going to say the market has fallen about 29% so far this year. Now we're having an update last time I checked today, but we've had this horrible 2022 thus far with the market dropping. But see, while everybody is complaining about all the reasons why the market has dropped, of course, inflation is rampant, Fed's raising interest rates. There's a lot of things that I consider to be catalysts for why the market price is dropping. But the one thing that I, as a value investor, want to make sure that you are subscribers to this channel, watch these videos, the market had gotten excessively overvalued. And therefore, I believe it was very vulnerable to any bad news like that. Now, expectations for growth are still expected to be reasonably strong in all these categories that I talked about before. So let's go to the forecasting calculators. Earnings growth is still expected to average about 8.9% over the next 2.25 years. So that's, adjusted operating earnings. Operating cash flow is expected to grow at about 6%, just slightly less over the next couple of years. Going to that all-important free cash flow I talked about, it's still expected to grow at over 11%. And then looking at EBITDA is expected to grow at over 12%. And finally, looking at sales growth is supposed to remain above 8%. So when you're looking at all these things, the market is certainly trading at valuations that make a lot more sense. Now, is the market perfectly valued yet? I still consider the market to be moderately overvalued, but it's close enough to fair value now that I would call it full valued rather than overvalued. But remember, as I often point out, it's a market of stocks and not a stock market. So I put together a portfolio of the top 20 constituents of the S&P 500, and then I've listed them here in order of earnings yield. Now, these are all extremely high quality, A-rated or better companies, with the exception of Abbvie, which is BBB plus, one short, and then, of course, Tesla, which is only BB plus. Otherwise, you've got really a list of blue chips, and, of course, Tesla's, as I did in a previous video, is one of the best performing stocks of all time, possibly. You could argue that. And so, the reality of it is these are all extremely high quality companies, and some of them are still overvalued, but we're getting a lot better valuation as a result of this correction than we've had in a long time, and we've still got some pretty good optimism. So what I thought I would do now in the remaining of this video is do a high-level view of the top 20 constituents of the market. The top 5 companies, Apple, Microsoft, Amazon, Tesla, and Alphabet, both A and C, represent over 21% of the value of this whole S&P 500 stock market. Okay, in other words, 5 stocks represent 25% of the value. And, the biggest one is Apple at about almost 7%. Microsoft is 5.6%. Amazon is 3.3%, Tesla is 1.96%, and Alphabet is Class A is 1.93%, and Class C is 1.71%. Then we start getting into lower levels as far as dollar weight, and we get Berkshire Hathaway at 1.59%, UnitedHealth Group at 1.54%. We've got Meta, or Facebook, if you will, at 1.01%. Visa is just under 1%. Procter Gamble is just under 1%. So what I'm going to do here is just at a very high level go through this portfolio of these stocks and look at it from a standpoint of what valuations have looked like this year. And I'm going to do it again. I'm going to do it for the last 15 years so you get a good perspective. Now you can see Apple has, been very volatile this year. It fell precipitously through June, then it rallied, and now it's fallen again, but it's still, in my opinion, slightly, well, I would call Apple fully valued. I would stop short of calling it overvalued. And again, that depends on, what you think of growth and how much growth you're expecting. But again, it's a whole lot better today, Apple, that is, as far as an investment than it was at the beginning of this year. And I think that's important. Moving on, Abbvie has been undervalued. It's probably held up as well as most of these stocks have done. I do consider it still undervalued with a high dividend yield, but you can see that it has dropped, since the beginning of this year, although it initially rallied and then dropped, but it's done better than most. So Abbvie still looks, pretty good here. Berkshire Hathaway got significantly overvalued through April. And now, we've had a nice, drop. At its normal PE of 22, it looks attractive, slightly undervalued. I still like to see it, a little cheaper before I'd be interested, like I had the opportunity to buy it in 2011. That was, that's where I'm looking to buy stocks. CVX, we know what's been going on in the oil sector. It's one of the few that's actually done well in 2022. If anything, the stock has actually gone up in 2022, although it has been volatile, but it's actually appreciated about, over 40% in 2022. And that's because it was so distressed. That's where valuation becomes so important. Moving on, if we go to Google, I call it Google. It's Alphabet, of course. It's still Google, and the symbol's still GOOG. It has fallen dramatically since the beginning of this year, as did Google L, the original parent company. Very similar results. It's really the same company. Home Depot, we've seen a nice correction in Home Depot stock. I rejoice at these things because now I've got valuations on names like Home Depot and Google and so on that are starting to be where I can buy. Even the great AAA rated Johnson & Johnson has fallen down to maybe a premium valuation of 16-ish times earnings. But it's a lot better buy today than it was earlier this year, and I think that's what this bear market is bringing us. JP Morgan is a financial, and it's been undervalued in my opinion. It did rally a little bit, through May of 2021, but, it has fallen precipitously in 2022, but I consider it significantly undervalued at these levels. Eli Lilly is one of the, outliers here, one of the companies that's actually rallied dramatically, and it's actually up strongly in 2022. Remember, it's a market, a stock, and not a stock market. So even though the market's down, Lilly has actually rallied, but I also would consider Lilly dangerously overvalued at these levels. Moving on, Mastercard has really kind of flattened for the last 2.5 years or so, and we've had a nice correction this year, and it's getting to the point where it's a lot better investment. I still consider it overvalued, but it's a lot better investment than it was a few months ago. Meta Platforms is an interesting case in valuation. Earnings growth has fallen, is expected to fall dramatically in 2022, and of course stock price has fallen with it. What happens going forward is really what matters the most, and there's really not a lot of growth expectations for the next year or two. Longer term, we're only expecting 6% growth. So, Meta Platforms is probably a better buy today than it's been in a long time. But, at the other hand, the company does have some issues going on, and that's, part of the package evaluation. If it's going to recover, now might be a good time to look at it. Moving on, the mighty Microsoft. Microsoft originally came out of the Great Recession and traded very nicely and very attractive, even got into some single-digit PE ratios back in 2011-12. What a terrific time to buy this company. It got significantly overvalued, and I talked about that. I did videos on it, and now we've seen a significant correction in Microsoft, and I do still consider it fully valued, if not overvalued. But the bottom line is it's a lot better buy today than it was. Maybe I'll get my opportunity to buy, because we're looking at really some of my favorite companies in the world here. Nvidia got ridiculously overvalued. When a stock is overvalued like this, like I keep pointing out, you end up hitting a down year like they're expected to have in 2023. And, the stock collapses. This has been one of the worst performers of the group, but it's also one of the ones that was most overvalued. But it's a powerful growth story, and it's been a powerful growth story, and it's still expected to grow at relatively high rates longer term, double-digit rates at least. So you're looking at, a stock here that was massively overvalued and now has started to get reasonable. Pfizer, obviously had the Pfizer vaccines. There's a lot of controversy going on right now. The market does expect earnings to fall. The stock has participated in that expectation so far. Procter Gamble is a blue chip dividend payer, AA rated. It classically trades at a premium valuation, but it doesn't grow very much. It does offer a decent dividend yield of 2.94, but I like to buy this stock when the dividend yield is well in excess of 3% if you're going to buy it looking for income in a very high quality company. But again, Procter & Gamble is a lot better buy today than it was at the beginning of the year. But I still don't consider it, massively undervalued, even though we've had this drop. Tesla, I recently did a video. I'll be launching this video here on this, probably tomorrow or the next day, maybe Monday. I'm working on a Tesla video, and I give you all the reasons that I like it. But you can see it's had a major correction as well. But I still don't consider Tesla extremely cheap. But in some metrics, it is. So we'll save that for my video. UnitedHealth Group is one of the outliers like Eli Lilly that's, done very, very well in 2021 with a lot of volatility, but I consider this one extremely overvalued now relative to where it should be valued. But I like this company very much as a long-term investment. Visa was one of my largest holdings for many years. It got too overvalued for me to, continue to hold anymore. It's now fallen below its normal price to earnings ratio that the market, but I still like it down here at around 15 to 20 times earnings rather than 24 times earnings like it currently trades at. But once again, Visa is a lot better buy today than it was just a few months ago. And Exxon is very similar to what we saw with Chevron. The oil industry has been in a funk here lately, but oil prices have risen and the stocks are starting to earn a little money. And it has one of the ones that defied the overall market. It's a market of stocks, not a stock market. It's actually risen in value. Well, my whole objective here today was simply to give you guys a perspective of the overall market and not just, be panicked because the market's dropping, but talk about why. Now, of course, we do have high inflation. We do have the Fed raising interest rates. We have a lot of things that I talked about in the write-up that I've added with this video. But I did want everybody to see how much valuation had an impact. And I want people thinking that what's happening here, where a lot of people are seeing risk, I'm seeing opportunity. We're finally getting the opportunity to see stocks trading at sensible levels again. Anyway, this has been Chuck Carnevale, co-founder of Fast Graphs, aka Mr. Valuation, gleefully talking about the value that I'm beginning to see in the market. I'm ecstatic of what's happening. Obviously, it's painful. I don't like it. I've even been holding more cash in portfolios than usual because of the high levels that this market was showing us. But I do think we're starting to get a correction here that is bringing stocks into more reasonable levels as we look forward. It's always going to follow bad news. That's almost the mantra. Stocks that are unpopular are stocks that have some issue somewhere. And in this case, we've got an issue going on with the overall market. But the big issue, in Mr. Valuation's opinion anyway, was the stock was overvalued. Anyway, this is Chuck Carnevale. If you liked the video, give me a like, ring the bell, subscribe to the channel if you haven't already. I'll be talking more about a lot of the stocks that I covered today, and I'll be starting to show you some value that I'm starting to see show up in future forthcoming videos. Thanks for watching, and talk to you guys again real soon.